So welcome everyone to this seminar by Professor Terry Odean from Berkeley. So we are delighted that he's here. And I'm also delighted that we have faculty and students from Singapore, I believe Rutgers, and all over India. So we look forward to your talk, Terry. It's called Leveraging Overconfidence and co-authored with Brad Barber, Xing Huang, and Jeremy Ko. Thanks, Terry. It's over to you.
All right. Let me see if I can get this set up just a second on my end.
So sorry, quickly, Terry, just sorry to interrupt. The way we do the seminar is that the first 5 minutes, we don't ask any questions. We let you talk, and then we open the floor so people can ask questions.
Sure. And that's great, but I don't mind being, especially if I say something you don't understand, just ask me. Or do you see my screen?
Yeah, we do.
Okay, great. All right, so this paper's called Leveraging Overconfidence, and it is about overconfidence and the use of leverage by retail investors. Basically leverage the use of margin and other ways of trading that use leverage. The hypothesis that we are testing and proposing is that overconfident investors are more likely to use leverage, that for retail investors, using leverage usually leads to worse outcomes. And so let's see here. Oops, there we go. So on the theoretical side, there's already, papers. I've written a couple. Many other people have written letters that, written papers that suggest that retail investors will be, that when they're overconfident that they're going to trade more aggressively, they tend to diversify less, and their performance is worse. Empirically, again, there have been, we just cite a couple here, but many papers that show that retail investors, on average, don't perform that well, and those who trade more aggressively tend to do worse. So one thing we do in the papers, we have a theoretical model with a fairly typical setup. Investors receive a noisy signal about the asset value. If the investor is well calibrated, they say not overconfident, they know just how precise the signal is, but the overconfident investors think their signal is better than it actually is. And what we add to this is we assume that investors have a budget constraint, but they can choose to borrow. So they only have so much that they can actually spend their own money, but they can borrow. And what we find is overconfident investors in the model are more likely to use margin. So if you assume, like this case, that there are high skill and low skill investors, and the high skill ones are the ones who are getting better signals, the low skill ones are the ones who are getting less precise signals. If investors are well calibrated, if they're not overconfident, then investors with more skill are more likely to use leverage, because they rationally say, I have a better signal, it makes more sense for me to take on this additional risk for additional returns. So the use of leverage is going to increase in skill for those who properly assess their skill, but it also increases in overconfidence for those who are misassessing their ability. So overconfident, low-skilled investors end up trading more speculatively, performing worse. And those who use margin trade more and more speculatively and perform worse. Okay, so there are two empirical parts to this paper. The first part is based on survey data from FINRA, which is a national organization for the finance industry. They ran a couple of large surveys, and we use data from those surveys. So the first survey was 500 people in each of the 50 US states. And the second survey was a subset of the original survey and people who had responded to the original survey. And the subset were all people with non-retirement investment accounts. And they got 2,000, that was a smaller survey. And we're looking at 1,600 people who took the second investor survey. We also have their responses from the original broader survey. And then we also look at the data from the discount brokerage firm that I was able to get data from almost 30 years ago. And there we find that that both cash and margin investors underperform the market, but that people who use margin tend to underperform more. So we're studying retail investors, and we're not arguing that all retail investors are overconfident, just that retail investors are more likely to be overconfident. They have less experience. They get less useful feedback. We don't claim that all institutional investors are properly calibrated. There are, one could argue here, I guess, on the slide, LTCM, long-term capital management. Some of you will remember it was the most famous hedge fund back a little over 20 years ago. It had, Myron Scholes and Robert Merton were two of the founders. John Merriweather, who had been, a star trader at I think at Salomon Brothers, and so these were, it was this this very successful, high-profile hedge fund that made money very consistently for several years. However, it completely blew up, and they, went out of business. And it turns out some of their positions were leveraged as much as 40 to 1. And the one interesting thing is that ultimately their positions paid off, but they were so leveraged they couldn't, they couldn't stay in business. They were getting margin calls, and that, it would be reasonable to argue at least that part of what on with them was that they were overconfident. They were perhaps too sure of themselves and took too much risk. There were a lot of people heavily leveraged in the real estate bubble, the residential real estate bubble in the US. And there's some evidence that people had mistaken beliefs. There's lots of anecdotal evidence that people had mistaken beliefs, but some academic evidence. There's evidence that CEOs are overconfident. And if you go back historically and look at historical sort of bubbles like the South Sea bubble, people who were using margin tended to end up worse off and were over extrapolating. Okay, so we're not claiming that all.
Can I jump in here with a couple of questions?
Yeah.
Kind of unrelated questions. One is this notion of leverage. In your story, overconfident people are more likely to have margin accounts. That is, they have they borrow, right, to invest. So my first question has to do with this causality, which I don't know if your data can provide evidence on. So could it be the other way around also, that people who hold margin accounts start trading more, and with experience, overconfidence doesn't pop up all of a sudden. It has to come from some experience, right? That you did well and then you become overconfident. So this causal question is one question, and the other one is kind of unrelated, maybe a very far left field. Going back to Jensen's 1988 kind of work, where leverage, if you use leverage broadly, leverage can actually be a good thing. It can make people more conservative, work harder. And so there's a benefit also here. So you're kind of, in a sense, you're skewed you're focusing on one aspect of leverage is what I would, so those are the two questions or comments I have.
Yeah, that's sure. I wonder if Jensen would still say that. That was more of a corporate setting though, right?
Yeah. But because you had a corporate site there, so I thought I'd throw that.
Yeah. So one thing that we do look at that partially addresses the question that you're asking is we differentiate between people who have margin accounts and people who take advantage of having a margin account. Who trade options, who trade short, who do leverage trades. And as far as how people get to be overconfident is multifaceted. And I wrote a paper with Simon Gervais along the lines of what you're saying, that one way to get to be overconfident is through experience, through having good outcomes and a tendency to attribute good outcomes to your own ability and blame bad outcomes on bad luck in other people. And so that learning bias can lead to overconfidence. That would be driven through trading. I think another way, and we see some evidence of this, is that people who are less sophisticated investors to begin with have a tendency to overestimate or misestimate their ability. And now you could get that even if they were unbiased in their misestimation, but had a greater variance. Then what you would find, and it's probably somewhat true, that people who know less, some of them underestimate. They just say, I know nothing. But there's a whole group that end up thinking that they know more than they do. And maybe just thinking that investing isn't easier sort of like game to play. I find that when I'm teaching students, I'll sometimes bring up the question like, well, when you place a trade, who do you think is on? And I always have students who, who are trading. These days, I think a third of my undergrads have traded on Robinhood. We did a poll during class last year. I think about a third had, and another 15% were thinking about doing so. So, and I said, well, when you place a trade, who do you think is on the other side of that trade, and why are they buying from you or selling to you? And most of the students have never thought of it that way at all. They're thinking of it more, I think it feels more like a video game to them, where they're playing against a game rather than a zero-sum game where they're playing against experts. So I do think that some people probably start off with what you might think of as overconfident priors, and then experience can lead to growing overconfidence.
Question: could you use a measure of diversification? Do you have a data of the diversification of the accounts or lack thereof as a measure of overconfidence?
Yes, but when I wrote that, I wasn't taking under diversification as a measure of overconfidence, more arguing that it is one of the implications. And there, to be quite honest, it's very easy to show that it's a theoretical implication of overconfidence. I think it would be wrong to assume that it's the main driver of that overconfidence is the main driver of under diversification. I think the main driver of under diversification is basically a lack of understanding of the benefits of diversification and the risks in market. I was giving a talk to financial advisors and practitioners once. And I was just running through it. I said something positive about diversification. It was not the main point of my talk. And one of the guys raised his hand and said, you academics are always talking about diversification. Well, Bill Gates didn't get to be the richest man in the world by diversifying. And so my response was, yeah, you're absolutely right. And if you hold a well-diversified portfolio, you will never be as wealthy as Bill Gates. Of course, if you hold an undiversified portfolio, you will also never be as wealthy as Bill Gates, but you could end up losing all your money like employees at a company called Enron did, when many of them had all of their lifetime savings in the company's stock, and then the company went bankrupt. So as far as the evidence goes of under diversification, that's fairly easy. I've got data on retail accounts, and the retail investors hold on average 3 or 4 stocks. Certainly that's not diversified. These days, the differentiation between people who are well diversified and not is mostly one of, are you primarily invested in mutual funds, in which case or ETFs, in which case there's a reasonable chance that you're diversified, though it's not guaranteed, or are you trading individual securities? All right, so what we're saying is that overconfidence can increase the use of margin, and that people who use margin because they're overconfident, it probably hurts their returns. We think that the use of margin can basically magnify sort of the outcomes of people who are otherwise biased, and usually the negative outcomes for retail investors. And so it hurts margin could, to some extent, exacerbate the amount of trading that's driven by the biases of individual investors, and that would possibly affect asset prices. I'm more interested in the welfare side and just saying, so how does it affect the outcomes for the individual investors? So the studies I was talking about, as I said, there were two surveys, the state-by-state one, which and then a subset of the first survey, and this subset was people who had non-retirement brokerage firms. And we're looking at 1,601 people who responded to both surveys and had all the information that we needed in the survey. So one of the things that these surveys did is they asked people to self-assess their investment ability and their investment knowledge and their financial knowledge. So they were assessing themselves on a Likert scale. And then they also had an investment quiz and a financial literacy quiz. And so we take a look at how people rank themselves, and then we put it in percentiles because you get more people ranking themselves in some places than the other. So we figure out percentile ranking in the 1,600 investors based on how people rank their self-assessed their financial literacy. And then we rank them based on how they did answering these questions. And the differences in their percentile rankings, the self-perceived ranking versus how well you actually did compared to the other people in the sample. That's our measure of overconfidence. And we have one measure for financial literacy and another for investment literacy. Now, these are the 10 investment literacy quizzes. I know this is very small print. So here are the first two. Yeah.
Could I interrupt and ask a question? Does it matter
sure.
if it is an up market or a down market for margins? Because leverage does well in up markets on average.
Yeah, leverage is going to do well in up markets. So it will matter in terms of outcomes. And I would say if you know that it's about to be an up market, it's like saying, buy the market. If you knew what was going to happen, then you could switch between a strategy of being levered and not levered. But of course, we don't know what's going to happen. So are there ever situations where the individuals end up well off because they were levered? Of course there are. But on average, these retail investors are underperforming the market, and leverage leads to greater underperformance. But that doesn't mean, there will be situations in which it does work out. So the financial or the investment literacy, just an example of the types of questions they're asking, which are not too complicated. If you buy a company's stock, and the answers are you own part of the company, you've lent money to the company, you're liable for the company's debts, and the company will return your original investment to you. I think that says, I cut it off there, I think with interest. And if you buy the company's bonds, you own part of the company, you've lent money to the company, you're liable for the company's debts, and you can vote on shareholder resolutions. So these are fairly basic questions. The financial literacy questions, also pretty simple. Like, suppose you have $100 in savings account, interest rate's 2%. After 5 years, how much money would you have if you let the money grow? And the answers are more than $102, exactly $102, or less than $102.
May I ask a question here?
Yes, sure.
Would it help if one were to measure the mean reversion, the speed of the mean reversion of the leverage rather than leverage itself, to see how quickly they sort of settle back to the leverage levels that we were comfortable with, because that.
What do you mean the mean reversion of the leverage?
Yeah, in the sense that say individuals' leverage levels are going to be time varying depending on the market condition, the margins, the extent to which they do margin funding on their account, right?
Right. I think right now I don't have the data to measure that with sufficient precision. What would we expect to find? I would expect to.
Yeah.
Huh?
I was thinking that the less overconfident may mean revert much faster.
Yeah, what I think you'd probably find is what we find in general in terms of trading behavior, which is subsequent to, as you go into a bull market, if the market's been really strong recently, people are more likely to buy, they're more likely to trade, they're more likely to use leverage. Almost certainly that's what you'd find. And then if the market continued to be strong, that would be positive reinforcing, but sooner or later it'd go the other way. We have a paper, I mean, you can think even I've got a current working paper where we look at investors at the trading firm Robinhood. And we look at herding events. And these herding events usually have a pattern sort of like this. The stock, something happens and the stock price starts to go up. There are some Robinhood investors that start to buy it early on. The stock price goes up more. Then a whole bunch of them buy it and it goes up even a little more. And then it comes back down and they continue to own it. And actually, on average, they even buy it a bit more as it comes down. And there are almost certainly some investors The ones who got in early make money because of this pattern. But when we look at the group, they lose money. Too many of them come in too late. And so I expect that what you'd probably find with margin, Robinhood fortunately doesn't let their, I don't think they let their investors trade on margin right now. I might be wrong about that. But I think that you would find a similar sort of pattern, that the use of margin would go up as prices went up. And when you, at the point that it peaked, you'd have a lot of people who are margined. And one of the problems, as you probably know with margin, is that if you get a sharp drop, unless you have more money, you don't have the option to stay in. You know, the only one time I ever had a significant margin position, I got the rug pulled out from under me. You know, a broker called up and said, you know, you have to be in my office with a cashier's check for $10,000 by 3 o'clock this afternoon, or I'm liquidating your position. And I thought it, I just said, okay, let it go. I can't play this game every day. All right. Okay, sure. So one thing that we find in the survey is roughly a third of the respondents have non-margin accounts, cash accounts that they're not allowed to borrow on margin. Slightly over a third have margin accounts, and slightly, again, roughly a third just don't know the answer, which isn't too surprising. The selection into the survey isn't based on being highly sophisticated. Of those who have margin accounts, 82% respond that, yes, I have a margin account, but I've never traded on margin, and 18% respond that they have used margin. Now, this is looking at breaking up the results from our from the financial and investment literacy questions based on whether people have a cash account, those who have a margin account but have never traded on margin, and those who have traded on margin. And what we find, so if you start on the left, that's for financial literacy. The light green bar is how people rate themselves. The dark green bar is how well they did on the financial literacy questions. And what you can see is the people with cash accounts are pretty well calibrated. If anything, they are ever so slightly underconfident. If you look then at people who have margin accounts but have not traded on margin, they're a little bit more knowledgeable than the people with cash accounts, and they're quite well calibrated. So they are assessing their knowledge pretty accurately on average. But when you look at the group that actually reports that, yes, I trade on margin, their self-assessment of how much they know about investments and finance is higher, especially on investments, far higher than any other group, and yet they know less. So they tend to be overconfident in the sense of they think they know more than other people, and they actually know less. Oops. Whoa.
Terry, is it possible that, there are some personality differences? You're talking now about 7% of your sample that have used margins. Is there some bias in the way that they answer the questionnaire? Do they have less patience, for example, to read it carefully?
Let's see. One second. I don't know, right? So I wouldn't be surprised. Are you familiar with the cognitive reflection
No,
the
no,
test?
unfortunately.
Okay.
No.
There are these, Shane Fredericks came up with this cognitive reflection assessment, and it asks people a question that if you take a moment, there are 3 questions in this simplest form. And if you take a moment, usually you can figure out the answer, but there's a answer that comes to you quite quickly that people will often give this wrong answer because of a lack of reflection. I wouldn't be surprised to find out that retail investors who use margin have less cognitive reflection and are more impulsive. So I suppose that could correlate with not answering questions correctly as well. As I say, the questions are pretty simple. So if I understood correctly, you'd say maybe it's not that they don't know much about markets, maybe they're not patient enough to answer the questions right, to even read the questions. I think that's possible. But in that case, what we would be saying is that would be sort of an argument that people who are impulsive and don't cognitively reflect are more likely to use margin. And I think that's probably true. Okay, so, oops, I just lost my, oh, here we go. Sorry. Let's see, a couple things about people with margin rather than cash accounts. In the surveys, there are questions about your willingness to take risk. And we do find, not too surprisingly, that the margin, the people who use margin report being more willing to take risk. They tend to own more stocks, and they trust the markets and trust regulators more. Wait, sorry, and then if we also compare people with margin who have traded on margin, people have accounts but haven't traded on margin, we get a somewhat similar results, that the people who trade on margin report that they're more willing to take risk, they own more stock, and they tend to be more trusting in markets and in regulators. So they have more trust. Does overconfidence affect margin use? We basically run these regressions. I think I'll move a little more quickly here so I get through the talk. And what we found, what we find is, if you go back, that having a margin account as a left-hand side variable, you find that overconfidence predicts that the people who are overconfident in their survey response are more likely to, they are more likely to use margin. But we also find that people, there's a combination. Those who do have a higher investment literacy are also more likely to use margin, and the two effects complement each other. So those who know a little more and think they know a lot more are the group that's most likely to actually use margin. And we get a similar result with the financial literacy. People who are overconfident are more likely to have margin accounts. And then there's one other question that we ask people. Just one second, I'm going to change how I'm set up here. Sorry. I'm going to take that down. And see, am I still, oh, take it down a little further. You can still see me okay, right?
Yeah.
So there's one other measure of overconfidence we use in here, which is how well you think you're going to do compared to the market. And that's a very intuitive way of thinking of overconfidence. You know, if someone said, I'm going to do better than the market, that sounds like overconfidence. And we use it, we get the result that we expect. People who are overconfident in that sense are also more likely to have margin calls. The problem with this measure is that if you believe the market goes up on average, then you could quite reasonably say that, you know, even if I just hold the market portfolio, if I use margin, I can expect to outperform the market on average. So I don't think that's what drives this result, but it's why we don't emphasize it as our measure of overconfidence, because a rational person could say the very fact that I am leveraged means that I will probably outperform the market, although you're taking on more risk in the process. And again, we get the, you know, the upshot is we get the same result whether we use the financial literacy or the investment literacy measure of overconfidence. We find that those who are more overconfident are more likely to have margin accounts, and they are more likely, in this case, to trade, you know, to have actually traded on margin. So that's what we're looking at here. And we find the same thing. The effect is a little bit less strong for financial literacy, financial overconfidence than it is for investment overconfidence. And it's, yeah, sure.
Yeah. So did you check whether those guys, those who are overconfident using margin account, are they picking up risky stocks, meaning stocks with high leverage on their balance sheet or glamorous stocks? So do you check the nature of the stocks they're picking?
So in the survey, we're totally unable to look at that. So what I'm about to show you is then data from a brokerage firm.
Yeah.
And I don't think we did look at that, although I think it'd be an interesting thing to look at. Yeah.
Good.
So we might be able to just look like.
What I was thinking is that, are they investing in highly levered firm? Because, you know, if they're overconfident about the market, then, you know, the option value of a company with high leverage is higher in up market. So if you can look at the type of firms or stocks they're picking, it might also give or reinforce the story on overconfidence.
Yeah, I think you're right that, you know, and we've not looked at it. And, you know, I'll talk to my co-authors about whether we can do some measures of, you'll see in a moment when we look at the people for whom we have the trading information and their accounts. We do find that they trade more actively, they trade more speculatively, speculatively in the sense of that that a lower percentage of their trades are likely to have been made for tax reasons or rebalancing or liquidity demands. So I think you're right that one thing that we could also look at is whether they tend to invest in more volatile, smaller stocks with characteristics that would make them risky.
In Journal of Finance that in a hedge fund, guys who are sensation seeking, they're investing in those kind of stocks. So that's why I was thinking.
Interesting. Okay, cool.
Oh, thanks.
Yeah. So the brokerage data, you know, it's 91 through 96. It's just, you know, the data still gets used. I get asked like 3 times a week for researchers who want to use the data. And by the way, I'm willing to share it with, you know, academics, PhD students, and you know, professors who are doing research. It's now, you know, 25 to 30 years old, but it's useful because it's account level data at a brokerage firm in the US. We look at people who have a non-retirement account and only one type of account, and who trade at least once. So here we find, actually at the brokerage firm, for the people who have non-retirement accounts, about 2/3 of them have a margin account. And it's probably because the brokerage firms encourage people to open up a margin account. They make it sort of as if it's the default. If you have a margin account and you never use any of the margin features, it's no different than having a cash account. So what they'll say to people is it has advantages and no clear disadvantages, because you're not required to trade on margin. But it allows people, if they have a margin account, they can trade on margin, they can sell short, they can trade options. And usually you can't do any of those things without a margin account. One of the reasons that the brokerage firms like you to sign a margin agreement is that part of that margin agreement says that the brokerage firm can lend your stocks out to a short seller. And the brokerage firms make money doing that. And the vast majority of retail brokerage firms don't give any of that money to the person whose stock was lent. There are a couple of retail firms that share the profits with the actual owner of the stock. But this firm was not doing so at this time. And then 13% of the people of the total sample, we classify as having used margin. So what do we find? What we find that's consistent with our model and our hypothesis is that people who have traded on margin tend to trade a lot more actively than the other investors at this firm, and they trade more speculatively. So we defined for this paper speculative trades as if you sell something and then buy something within 3 weeks, it's speculative in the sense because it wasn't probably a liquidity demand. You didn't sell because you needed the money. We also say the sale has to have been for a profit. So that means it wasn't motivated for tax reasons, because it makes sense sometimes to sell your losers for capital gains tax purposes in the US. And then I think we have the other requirement is that you're selling your entire position. So it doesn't look like you are, it probably wasn't the sale didn't have the motivation of rebalancing. So people trade more actively, more speculatively. If you look at the differences are statistically significant. The turnover by the people with margin accounts versus those with cash accounts is statistically significantly higher. And the same is true for speculative trading. We actually also look at a tendency to have the disposition effect. The tendency to hold on to losers and sell winners. And we find that that is higher with people who have margin accounts. And then it's also even much higher with people who have traded on margin. And I have another working paper that shows how the disposition effect can lead to overconfidence. And so we find the same results comparing people who've never traded on margin to those who have. It's basically what was in the chart that I just showed you. It's just showing that it's statistically significant. The demographics, the brokerage data has some information about a questionnaire that people ask when they open up their account. Not everyone answers it, But for those who did, you're asked about your investment experience and your investment knowledge. And we find that people with margin accounts rate their investment experience and their investment knowledge higher than people with cash accounts. And that people who actually trade on margin rate their knowledge and experience higher. That's consistent with what Srini was saying at the beginning, which is that maybe with experience, that leads to growing overconfidence. I suspect that there's some truth to that. As I say, I've written a paper that claims that's true, so I'm not going to argue with it. It's also consistent. It's an interesting thing about knowledge when it comes to the individual investor. So if you have an investor who knows the price earnings ratios for 500 stocks and knows, what all about, the dividends that have been paid and has a bunch of information, and you have another investor who just buys Vanguard index funds, all market index funds with an annual fee of 5 cents for every $10,000 or something, like with a minuscule annual fee. The first guy is more knowledgeable, but in a way, who's more sophisticated? It's hard to say, but the person buying the Vanguard fund is following what most financial advisors and academics would say is the optimal strategy for most individual investors. The other person knows a lot, but that knowledge may not be leading to optimal outcomes. So again, this is just showing that these differences are statistically significant in a regression setting where we find that turnover is higher, statistically significantly higher for people with margin accounts, and additionally higher for those who trade on margin. The same is true for speculative trading, and the same is true for the disposition effect. Let's see. We basically do an event time and calendar time analysis of returns for these people. And in the event time, we find that the people with margin accounts, their sells do worse. We actually don't find much difference in the event time performance of the stocks they buy for people with or without margin. But the people who have margin accounts are doing worse in event time in terms of their choices of which stocks to sell. And that ends up being true, and even more so true for people who trade on margin. Now, there is a mechanical way that this could happen, and I don't think it's driving the effect. But as I mentioned before, if you have if you're trading on margin and your position loses value, you either have to come up with more money and give it to the brokerage firm, or they will force you. They will just sell your position. So some of the bad sales, at least in theory, could be driven by forced sales. So I don't know whether these people are making bad selling decisions, or some of them are being forced to sell because they can't maintain their margin position. And now this is, okay, yeah, let me skip that, move to
Terry,
yeah.
Forced sales may lead to skewness. So a skewness may indicate that.
May lead to skewness.
In the distribution, yes.
Sure. So forced sales is suddenly going to put selling pressure on a stock. This is, the case study in this that I'm sure is going to be written by more than one person is the GameStop. Recently, there was this stock that, just went, that Robinhood investors and others were involved in, that went hugely high and low, and there were a bunch of short sellers. And there are these issues about, well, actually, the forced selling does. So what happens? They get forced to sell, and that would create, at least for the moment, this sort of skewness or feedback. And that's what happens with the margin. Now, on the other side, short sellers, when they get squeezed, it creates a skewness or feedback in the other direction. So there was a lot in the press about short sellers, that hedge funds were taking big short positions in GameStop and then being hit with margin calls as the retail investors drove the price up. And the short squeeze can lead to a skewness and a very rapid bump in the other direction. Let's see, we run calendar time returns, and the basic outcome is if used just a one-factor cap M or the Fama-French 5-factor plus momentum. Either way, the people who trade on margin underperform, and the underperformance is statistically significant. This is the same thing with just showing the table just shows what was in the graph. So to sort of wrap up what the paper is about, we say in theory, overconfident investors are more likely to use margin and to trade more actively and trade more speculatively. And for investors who are overconfident, this is going to hurt performance. In the survey, we find that people who rate their own ability, their own knowledge of finance and investments higher than it actually is, also report that they are more likely to report that they've traded on margin or have a margin account. In the brokerage data, we find that people who use margin trade more actively, they trade more speculatively, and they perform worse. We think that there's some possibility that margin could hurt market efficiency at times, like when retail investors are influencing markets in inefficient ways. Margin just leads to their market impact. As I said, my main concern is the other side of this, which is whether the use of margin is detrimental to the welfare of the retail investors. Any questions, comments?
So this is a general comment, Terry. Just if you look at the literature, if you think about the distribution of the population of human beings, I would speculate that some people are overconfident and some are underconfident, right?
I agree.
But it seems that the literature in all whether it's corporate finance or investing, seems to document that on average people or some segments are overconfident. Don't you think that it seems like the evidence is somewhat skewed and is not doesn't capture the population? In the sense, nobody's looking for underconfidence. It's almost like this herd effect. Everybody's saying, even the Malmendier and Tate CEOs are overconfident, investors are overconfident. So there's no search for evidence of underconfident investors, right? And those are the people who don't invest, so you don't see them. So it's kind of like a selection bias in some ways.
I agree. Actually, I've talked about this, but not written about it, in part because I haven't figured out how to. So I do agree that the other side of this is people who feel in a way so unempowered that they have the resources to invest, in markets but don't do so. And that might be your underconfident group. Now there's people in finance. I've sat in finance seminars where people say, isn't it puzzling that, half the people in America, it's a little less now because of 401k plans, but don't have any common stock investments. And my usual thought is, well, if you're worried about paying the rent, it's not that surprising that you're not buying common stocks. But there are people who have money to invest and are probably taking too little risk. And that would very likely, and I think it's a problem. So you're right, there's a selection bias. In fact, when I wrote the paper with Brad Barber, a paper called Boys Will Be Boys, our concern was, our hypothesis was that men would be more overconfident than women, and thus we'd find men trading more actively than women. Our concern was that there might be so much selection bias in the women who had opened up their own accounts that we weren't wrong in our original hypothesis, but we wouldn't be able to show it because we'd only be observing the most overconfident women. Now, as it turns out, we got results that confirmed, that were consistent with our hypothesis. But if I understand correctly, you're saying, look, we're only looking at the investors who had enough confidence to open up an account. And I agree. The other one is, now in general, the psychology literature finds that it's more common, and this is psychology studies, for people to have sort of what are termed self-serving biases that support their self-image of themselves, who they see themselves to be. That doesn't mean that there aren't people who err in the other direction. But there does seem to be this effect that on average, we're above average. On average, in many areas, we rate ourselves as above average. And when you ask people and you see that they are rating themselves below average, most people, when they do that, they'll rate themselves below on average on something they care about less. And they'll say, yeah, I'm not that good of an athlete, but I don't care about athletics. There was an interesting paper by Taylor and Brown, but this is entirely a psychology paper. It's even a clinical psychology paper, where they made a pretty strong argument, this about like 1988 paper, that people who have mild overconfidence and mild positive self-serving biases exhibit greater mental health on other measures of mental health than people who are completely realistic about who they are and what the future holds. So the people with mild optimism and mild overconfidence tended to be happier and live better. And people on average who are mildly depressed tended to be more realistic in the sense of, if you asked them what was to happen, or you asked them to rate what their abilities were like, and you had some objective scale, they came closer to being right. So in many areas of life, a little bit of overconfidence and optimism isn't such a bad thing. Part of what I've been arguing in my research on individual investors is that investing might be an area where it's fine to have enough confidence to have gotten yourself to Vanguard and bought that index fund, but it's probably not so good if your confidence went to the level that you are now actively trading small, highly skewed stocks and using leverage.
Thank you.
If I may have two questions or comments. One is the performance measure that you have, a loss of about 1/3% per day seems huge. So I wonder whether there is any reason
Sure.
for that. And
Right.
the second is, that's kind of outside the paper, but is there any way of characterizing the overconfidence or the information that they think they have about stock selection versus timing? Not my area, but I thought that may be interesting.
Yeah, I have no way of knowing what people think about timing. The only paper I've ever written that looked at timing was a paper using Taiwanese data. My co-authors were able to obtain every trading record from every investor, institutional and individual, in Taiwan. And we found, in fact, that as a group, individual investors had poor market timing, at least during our 5-year sample. That if you saw more investors coming into the market underperformed over the next 6 months. And if you found more of them coming out, it did better. What is driving that big shortfall in these, okay, this is what's driving the big shortfall in the event time is mostly losses on the day of the trade. So this would be the bid-ask spread, but the bid-ask spread plus kind of intraday bad timing. So that is where I'm sorry, because you can't, it's not absolutely clear when you look at this. But I know that's true because I'm working on another working paper right now, and looking at the same data set, we find that there's a loss of close to 1% on the day of the trade. And so that gets that would be a round trip. So I think spreads have come down, obviously. So I think you're right when you say that's a very big magnitude loss over a short period of time, and most of it was driven by the loss on the day of the trade, and a lot of that would have been the spread at the time. So these people, part of the reason that in this data set people do so badly who trade actively is spreads were big compared to now, and commissions were and we're not factoring commissions in this study. I'm not penalizing people for commissions, but when you actually want to study how well they're doing and you consider the commissions, active trading just kills them. They're paying a big spread and they're paying substantial commissions. These days, commissions are way down, and spreads are tighter, but the individuals are still losing money on the day of the trade. They still, yeah.
Can you explain, I guess, is their performance or because I see here that the margin and the margin experience have higher R's than the alternative groups.
Say this again.
If you look at the sales, the R's are the performance of those people or the performance of the asset that they sell.
So the sales, so if a sale has a positive performance, then that's a bad outcome for you.
Right. So that's the performance that they lost by selling. Okay.
Yeah. 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 All right. It's getting late for you guys.
Thank you so much,
Thank
Terry.
you.
It was wonderful to see you again, and
Wonderful.
enjoy the talk.
Yeah, I was very happy to get your email. It's been a long time. Yeah, as many of you know or might know, some of you might know, Srini and I were colleagues. We taught together at UC Davis more than 20 years ago now. All right. Okay. Thanks, everybody.
Thank you so much. Thank you
Take
so
care.
much.
Bye.
Bye-bye.